Good morning, everybody. See that, all that fancy stuff? Okay, so here we are. Once again, after another volatility event, price point up, price point down, volatility contraction, we get this, volatility expansion, we get this. And so the question is, how much of a volatility rally do we end up getting today? Volatility got jacked yesterday, and we're going to kind of go over the volatility setup, for lack of a better word, in a little more detail momentarily. I think that's kind of one of the most important tells in the whole setup right here. Just a brief recap. Yesterday was almost 2% top to bottom move. Let's go to the notes. Okay, so like I say, Tuesday was options engine shifting gear. If you remember from yesterday, we talked about how the local hedging was thin, especially below whatever the number was, 69.65 or whatever it was. There was kind of a big void, and we just kind of fell through it. We broke below 69.20, if my memory serves, which was another level where we had sold puts. We had some more down at 6,900 that appeared during the day. Volatility expanded. As we know, when volatility expands, the sharpness of the hedging response gets blurred, just to make it simple. And so we blow through levels. Not to mention intraday trading and scalping and all that kind of stuff. The expected move was kind of really expanded and nuts throughout most of the day. Very little, if any, straddle decay until later in the day. As we mentioned in the show in the morning, what the straddle was when we came on yesterday, 22 or 27, and me and Vol Trader both said that straddle sure sounds cheap. The reason why it was so cheap was we had that rally all the way up towards 69.90-ish, whatever it was, and we were right up against a big positive gamma area, and that's what happened. Okay. And then at the end of the day, like I say, he had tape repaired late in the day. His vol stopped expanding. So let's go quick over here. So let's look at the day kind of in the context of volatility for a minute. Okay. So yesterday, as volatility was going nuts and we were dropping, we got to a point here near 18, whatever, where volatility started to level out. All the shorts that the market makers had to hedge out the downside, we'll keep it simple, ended up having to be closed out. The expected move started to narrow. Then we went up through levels, and we ended up right near 69.20, which was a positive gamma strike that was there all day. When we were below 6,900, whoever the systematic fund was actually sold more puts, ballsy. I had a red day yesterday, an L. Had I kept my fingers off the mouse, it would have been a green day. Gave back half a day, not a tragedy. I'm not that guy that comes over here and tells you I never lose. Sometimes I lose. Here's Vol Trader. Was a good scalping day. Did make money on scalps, on different flies, whatever. So we're going over volatility right now, Vol. So at one point yesterday, the VIX 9-day was higher than the VIX. So short-term stress, short-term hedging more than long-term, Not that long-term was, longer-term 30-day vol was any picnic either. We had VVIX, let's get VVIX. We had VVIX spike to 118. The VVIX spike was commensurate with the spike in VIX, actually muted percentage-wise. It was actually less percentage-wise than the VIX was. And so it was kind of funny what was going on under the hood. Let me show you a couple of things. I have to go in here for a second. Indulge me, if you will. Where is it? This is the old server that the subscribers get. Okay, I want to show you two things. So this is from Scott Nations Index. It's off of Twitter. Scott Nations was on. I did a broadcast with him a while ago. I've done a little beta stuff with him. Weren't able to actually work out what I hoped to work out, but that's okay. So what do we see here? Basically, his version of a term structure, and what do we see? We see the real elevation is right around here, right around the VIX 9-day. A week out, heading into options expiration-ish February, kind of flattish, and then we resume somewhat of a normal shape, a normal slope, somewhere here, 60 to 90 days out. So this whole area here we have technically 30 days out is higher than 60 days out, based on his methods, not the VIX. So we have a mess here that's going to balance itself out. It always does. When we have these dislocations, they balance themselves out, sometimes quicker, sometimes slower. Okay. So takeaway Valdex term structure showing short-dated kink, and that flat thing I just described it. Okay. Now let's look at the decomposition index. This breaks down what parts of the VIX moved and what parts did what. Okay. And if you notice, downside convexity actually went down a little bit. Maybe they were at one point during the day, but by the end of the day, downside convexity went down a little bit. Most of the move was sticky strike shift, just adjusting the strikes for the vol surface, but parallel shift, which is kind of repricing the whole surface a little more expensive, also contributed. So long story short, parallel shift is bad. That's kind of vol repricing. Also potentially good when vol if vol doesn't realize. So that's basically the takeaway there. So what are you saying, Doc? So, one last thing. Again, at one point yesterday, the VIX and the VIX futures were basically equal, which doesn't make sense. Now there's about a 1 point difference, which kind of is more aligned, more in balance. So there's still stress there. We had not as bad of a setup, but a similar setup, whatever it was a couple days ago when we dropped whatever was 100, 100 plus points and then rallied 100 plus points. I don't think we have that extreme, and vol tends to cluster, so we could see another little vol event today, but all things being equal, the expectation is for vol to come out of the chain and for us to have at least a short-term bounce. At least that's my expectation. I wanted to look at this, and we've been looking at this the last few days. Remember we talked about this kind of being near the bottom. This is the VIX. This is the slope. There's a different way of seeing the slope of the VIX curve. We went through the math yesterday, and it's kind of bottoming here. Really, it looks like it's about to turn. Could it get a little lower? Sure. But it's closer to inflecting upward than downward. Let's take a look at one more thing while I got here. Okay. Again, the VIX VVIX ratio started to inflect up. We can expect an inflection here. We don't know exactly when. So it's looking like we're about to inflect, not saying it's over, but looking like we're about to inflect, and maybe it's over, maybe it's not. Okay, let's get back to the plan. And if there's any questions, okay, we'll get back to the chart in a minute. Okay, so like I said, front end vol, king tire. Okay, here I'm just kind of two-way competing force. Volatility can shove price around, and vol stabilize intraday. Charm can help the snapback line, not just charm, a Vanna rally, change in deltas, the whole Greek mess. Okay. And so now it's stopping bullshitting, letting it and get to the map. Okay, so we have PMI, I think, and ISM. Before the bell, we had whoever we had, Novartis was one that I noticed, or Novo Nordisk. I'm not in any of these. I don't have any trades in this group, so I wasn't really paying attention to it. Of course, we have some bigger names after the close. We have Google, the two Google brothers. I don't know why it's listed separately. Qualcomm, Lilly. Lilly, I think, is now in the $1 trillion club. So it's kind of a big weight. And we have just names of interest: Snap, Uber, Boston Scientific in the medical device space, Johnson Controls in the industrial space. We still have some medical stuff. So we have a broad read through coming in. We have team in the beaten up software space. By the way, software got beat up yesterday. That whole narrative is continuing and accelerated with whatever the Anthropic news is, whatever they have some new toy. And so the AI narrative du jour was worse on software because of that story, plus Jensen Huang kind of waffling on his commitment to putting money into OpenAI, Anthropic's competitor, which then caused a sell-off in some of the spaces adjacent to that, and even some of the like BlackRock, some of like the people that have exposed to loans in that space got beat up, along with Morgan Stanley, Goldman Sachs. Some of the other banks did well, depending on how they figured you were. So that was what was going on there. That was what was going on. Okay, so let's look at some levels and lines. So the expected move top, the expected move bottom, when I looked before 69.25 as reference, was 68.85, 69.65. Wide. One day vol was priced at around 14 and a half, 15, about 14 and change. So a little less than 1% in either direction, 50 points, 40, well, here it says 40 points, whatever it was. I like to put in Friday. I put in tomorrow just for fun because I have 1 and 2 DTE trades in. And I think in this environment, if you're a vol seller or even scalping, maybe give yourself an extra day or two for things to reset. And the EM bottom for Friday day is 68.40 and the top is 70.10. Now, let me show you something else. So here we are. And we could do the moving averages in the same thing. Despite all the mishigas, the craziness, technical term, we're right in the middle of the expected move. We had an engulfing bar, but then we managed to bounce up above it. For those of you of the candle persuasion, we had an engulfing bar. We could say this is a bottoming tail, a hammer or a hammering sickle, or whatever the term for that one is, bottoming tail. We closed near the up here, so I don't know. Is that good? What I do want to show you is that we're still right in the expected move. After all this nonsense, we're still right in the expected move for Friday. Let's look at the MAs while we're at it. The 69.35-ish is the 20 DMA, kind of right here, right above us. Nice to get over that marker. Some algos trade that. Look like the algos, to whatever extent they participated yesterday, jumped in and bought the 50-day on the undercut. And that's that part of the levels and lines. Let's go over here to options depth. Let me make sure I have the right day here, because I've been known to look at the wrong day and then make my plan based on the wrong stuff. Okay, no, I got it right. So what do we see here? Let's start with where we are. So we're roughly 69.20, let's say. Let's go back to 69.20, 25. Here's McGraw. Okay. Yeah. Posgex reaction. I'll show you what I'm talking about here. Intraday flip trigger. We have this whole mess right near where we are, and I'll show you why. Okay. So 69.30, where is it? So 69.20, so we're kind of like right in here. And we kind of closed yesterday right in this box. I've noticed a lot of times the daily close with the charm, what helps push the resolution over is where we are locally compared to the 1 DTE. I've just noticed this anecdotally, no back test or whatever. I've just noticed it. Happens more often than not that could be the deciding vote, so to speak. And it makes sense. It makes sense. Okay. So below 69.20, where we are right now, 69.15, 69.10, weak though, weak. And so really below 69.20, 69.15, we're back to a similar shitty setup like we had yesterday with 69, I think I said 05, kind of like giving us a little room here. But basically we have 6,900 minus gamma market maker, short customer long, 1,500 puts, 1,000 puts here, and another 700 puts here. So we have this magnet right down here at 6,900. And then a void down to 68.85, small, don't get overly excited. And then below 68.85, we have 68.75, round number, as a possible landing spot. And we kind of have some decent positive gamma here at 68.60. So really you could say 68.60 to 69.40 is a big mess, with the weight of the evidence pushing to the downside, fighting against volatility contracting, pushing us to the upside. And, you know, then below 68.65 and lower, then you have a lot more sold stuff. Above. Should we get above this 20 area, which we got in the overnight session, and stay up here, we have 69.20 to 69.40, stall up here. Reaction, sticky up here, or bounce between 20 and 30, maybe come back to 15 and come back in this zone. Over 40 is going to be hard slog. But again, depends on volatility. We have another fishbone back and forth ladder. Hard to say what price is going to do. Until we get up to 69.75, that's where the vol sellers come in. That's where they come in. And that's kind of the simplified version of the roadmap for today. Chewy won't be here today. He's got his 16-year-old puppy at the vet. And, you know, vet waiting rooms in New York being what they are. And let me see if I left anything out. Let's look at my notes. Dealer boxes, we talked about the dealer boxes, chop zone, blah, blah, blah. Oh yeah, the VIX ladder. Let's talk about that real quick. And, you know, this is the kind of stuff we kind of do all day in the room. Okay, so me just make sure I have the right expiration. I think I do. Okay, all good enough. Okay. So what do we see in the VIX? Now, right now I'm just going from the market maker's point of view, but actually, I like to look at the VIX from the customer point of view. I'm sorry. It's easier to think about calls. The customers are long VIX calls starting at 17. It's kind of where we traveled up this minus DEX ladder. Kind of a traction store right at 1920, the big level. We kind of get up there and then kind of scale back down that ladder. That's where we are in the VIX. Breaking over 20, even though it's positive DEX, it's hard because you stall out there. So they're hedging by buying VIX futures, which then spills over into the whole mess, which then makes the VIX futures curve thing kind of funky. And so that's what's going on. That's why we have it overnight, because liquidity is thinner in VIX futures. And so to the extent that they're hedging that, the VIX futures kind of get overextended one way, and then we kind of readjust. Let's just look at the puts. This is customer side. Puts, customers sold puts below 16. People are saying, 16 is kind of the floor-ish. Now, if we look at it net, and we go back to market maker positioning, the way our eyes are used to looking at it, think of this as support bottom area, 16, 15 and a half VIX, ladder up toward 20, with this 18 being the pivot where we kind of closed yesterday. That 18 is an important pivot on the way up toward 20 or not. And that's what's going on in conjunction with all this. So, it's not an easy market. It's not an easy market. Go feed the goats. You could easily do that. Okay. I think that's pretty much it. I want to make sure I didn't skip anything. Cheat card. Okay. So we have cheat card, flip line, bounce. Okay. That's pretty much it. Okay. Val, what do you got for us? Hold on.
Hey, good morning. How you doing?
I'm doing good. How are you?
Yeah, I'm okay. I'm okay. So let me share the screen. Okay.
You know when you got it.
Got it.
Okay. Well, I gotta take myself off, put you on. I'm gonna take care of a few admin things in the background. Go ahead.
First thing I want to mention is, and I talked about it a couple of times also with you, is the fact that 20 out of the last 30 days, give or take, I was long vol and made money. So in lame terms, I picked up the straddle at a certain point, could be Globex, could be during the day. And from that point on, 20 out of 30, the market moved more than what the straddle was for that session. Now, out of the 10 remaining days, half of them I didn't lose. Now, this is like, for me, is like mind-blowing. And this basically, this has like a dramatic meaning in the fact that the market maker doesn't really lose money, right? Because he's pricing a bid ask on the straddle, which derives from a synthetic bid ask of the future of the underlying asset, being the future if these are options on the ES, or being the SPX if those are options on the SPX. Now, I mini trade the ES, but it doesn't matter. The fact is that as I pick up the straddle, whether I leg in or buy it, it doesn't really matter. The the market maker sold me that straddle at least a 1 point higher than the bid ask of the underlying. So he immediately hedged that and made 1 point, okay, give or take. Now, obviously, somebody needs to lose money. So there's a chain of how that straddle theoretically is rolled, right? I bought it from someone, he hedges against someone else, that someone else hedges against someone else, and so on and so forth. But somebody in the market is consistently providing vol liquidity very, very cheap, right? Now, all market makers are constrained under the same model pretty much. Eventually, it drills down to how much they pay interest on, on the money they are required to provide that liquidity. So obviously, the spread is compounded by various components, but if somebody gets money very, very cheap, he can be much more active in the spread than others, right? And somebody's losing money on that, like consistently. Somebody's losing money. Now, I saw this phenomenon for a couple of months, but the last 30 days are like the statistics are pretty standing out. And this is really fascinating me. I'm trying to dig deeper as much as one can do outside of the community of the market makers, of course. And in my eyes, this is basically like part of a liquidity provision strategy that maybe drills down to the Treasury Department and the Fed, right? Who want to provide liquidity anywhere they can, and while they're not quoting the SPX or the ES, of course, they're not doing that, but there are some venues where they provide liquidity, which they know will affect the market in various assets, including options on different underlines. So I can't really figure out any other reason or any other outcome other than the Fed can print money and give it for whatever market and venues he wants, and obviously he prints it out of thin air, so he doesn't really lose money, right? He never loses money, so he's probably the end provider if we would go down that rabbit hole and go through the various sections of the chain. But obviously there's someone else that is able to provide this liquidity, and somehow we don't hear about any shop, any bank, any prop trading firm, nothing that went belly up.
Well,
But
the simple version is vol sellers like me, but not me so much as large systematic funds, have lost money, but not gone broke. And a lot of them are selling roughly a 6 delta and 8 delta. So even if we're outperforming, they're not getting killed. I might see where they're placed. So who's
no,
getting
that
killed?
wouldn't
I'm not
explain
sure
that.
who's getting killed. I
Yeah,
know it's a good
that
question.
wouldn't
Market
explain that.
makers can lose money when in negative gamma, not a lot, but that's a good question. Who's losing all that money? I don't know. I don't know who's losing all that money.
Yeah,
Well,
this might be
let's
spread
get to
out
go ahead.
over various strategies that are
Right.
becoming more and more popular. So every one of these strategies that turns around to the public and say, "Hey, we have this new strategy, new fund. If you buy the CTF, you won't lose more than 2%. You won't make more than 4%, right? You give him money, and you're basically losing part of the participation of the market, especially to the
Oh,
upside, right?"
structured products is another thing. All those
Yeah.
banknote structured products, that's a big source.
Yeah. So I mean, obviously the there's no one entity that subsidize the intraday volatility, right? There's a lot of entities. At the end, there's obviously the main liquidity provider, which is the Fed. But either way, there's something going on. I mean, I never saw it so pronounced for so long, like I saw the last 6 months or so. And the statistics are, back in the days, I would never buy vol. I mean, I would, you lose money. So, but now you're able, you get these instances where, with using your system, if you have one, right, which can pick very extreme mean reverting levels, those generally are a good exit for that straddle at break even or plus, right? And
And we both called it out yesterday that vol looked ridiculously cheap. It was like 22 or something, or 27, whatever.
yeah, almost every day it's like it's
Oh, it's a little pricey today. It's around 40 last time I looked.
yeah, I mean, after you have a big vol event, so obviously the vol is more elevated and it takes time to deflate. But
Right.
either way, there's something going on. We'll probably hear about it. It doesn't necessarily mean we'll hear about it this month, could be 6 months out. But whenever I'll find a real answer to this phenomenon, I'll share it. So that is in the background. That's the first thing.
And so
Second
how do we
thing,
make money today? How do we make money today?
yeah. Second thing is, so what you're seeing on the screen is part of my skew models. So we're seeing multiple skew models here, short term, a medium term, a monthly, so on and so forth. Now, we are more interested in the yellow line. You can see it has a trough in the middle, pretty much at spot 69.20 or so.
Can
This
you
was
blow that
captured.
up can you blow that up for the viewers? It's a little hard to
Yeah,
see.
this was captured an hour ago, so spot was around 20, I think. And you can see it has elevation into the 69.80 if you're going to the right of the chart, and the yellow line has elevation if you're going to 68.70. Now, these are the edges of the day, but mainly it shows that into the open of today, they are selling vol around 69.20 and buying the wings pretty wide. 69.75 top side today is very, very strong resistance from various models that I picked up. What's interesting today is that potentially this is a two-sided auction with a nothing day. So this chart, which I share a lot of times in the pre-market analysis, should have spot going left being negative values and spot going right being positive values. Today it's inverted. Now it happens sometimes it's inverted. This means that if you go down in price and spot, you'll get support and mean revert, and if you go up in price, you'll get resistance and mean revert. Now um, we had this 2 days ago when there was a huge mechanical short squeeze to the upside. And obviously, if you get news or anything that can generate a larger than the expected move today, then you crush through these dynamics and you basically end up closing at the high of the day. But I don't think this might happen. They did it 2 days ago, so I doubt they'll do it today. The market would find much more easier path going down rather than going up today. But the mean reversion aspect of it is there. It's pretty pronounced. Much harder for it to go up. But we'll also get mean reversion dynamics if it goes down. Now, one might say the market will be basically it will be in a waiting position until Google comes out. Right? There's like a lot of stuff, earnings and macros from now till Friday. So, and the market did a lot of moves up and down. So, yeah, it could just eventually end up here at 69.20, 69.30 or something like that. This is what the charts shows, the data shows, and these are the dynamics deriving from the data. But to the upside, I want to emphasize that to the upside, the market will have a harder time to hold any levels above without getting mean reverted. And to the downside, if it were to break the first support here around 6900, 6990, then it can close the day lower. and not find that mean reverting dynamic, right? If it breaks these levels, it won't find these. Now, in the background, we need to remember that the SPX on the daily chart is trading in that multi-month range between 6,800 and 69 and 7,000, and the shorter level is 6,850, right? That we were close to that level yesterday, and we were close to that level earlier this week. So that is like a very important resistance, right? A very important resistance that if it were to break, then everything would start to align to the downside.
We also have the 50-day moving average down in that neighborhood.
Okay, I'm not aware of moving averages, but okay, that just makes a point
stronger.
Adds
to it, right? That just adds
yeah, in that sense. So honestly, I'm not. Yesterday, I was more bearish than bullish. I thought the market would, might give a spike to 7,010 and then crash. Today, I'm not that bearish, but obviously not bullish at all, right? So if the market were to just zigzag up and down and eventually come back to these levels, 6,900, 6,940, and settle here, I won't be surprised. But I'll play it level by level. So transition-wise, an uptrend can easily develop from 69.35, 40, and upwards. If we were to reclaim those levels, that would help the market to try and test the upper resistance. And as long as we are under 69.20, we just drift lower with those mean reverting dynamics. And only if we break the yesterday's low, we would get like a real serious nasty downtrend. But other than that, we can go all the way down there and just bounce back up. That's pretty much it.
Surprised me if we didn't see maybe a similar variation to yesterday, not as extreme. So if conditionally we break that 6,900, 6,890 and fail to reclaim, then we kind of have that void down into negative gamma, into just kind of where there's nothing there. That would then, toward the end of the day, kind of have that charm rally as volatility would fade toward the end of the day as the straddle price contracts. Now, what I'm going to do is I like to keep especially in a situation like this, I like to keep my eye on the VIX 9-day, because that's what's roughly telling me what's in the chain for this Friday and next Friday. And that's going to have more of an effect on the hedging. Are they going to have to chase negative gamma down? Are we going to have some kind of, vol crush to oversimplify rally? So I'm going to kind of keep my eye on that as one of my main, canary in the coal mine kind of tells. Any questions here? I put the little Q&A sign up. Questions, comments, whatever. I don't really see any. We have numbers today, I think, right? I mentioned it. Let's just take a look again. Whoops. That's the chat. We don't really need to see the chat. We want to see, hold on, let me find what I'm trying to see. I got lost real quick.
Doc, one more thing. Would be interested if we were to list all the volatility funds. Doesn't matter if they do something similar to JP Morgan or just, volatility control, but all of those, and try to sum up the asset under management and see if we can find something meaningful there, right? I mean, the market is large, obviously. Even if we find a lot of funds, it doesn't mean that they have a lot of money. But I think it's an interesting space to look into and see if we can find some cracks there.
Yeah. Oh, and okay, so we have global PMI, I guess, today at 9:45, ISM services at 10 o'clock. So we got some numbers. the market seems to be very sensitive to that kind of stuff, even more so than lately. We have the Treasury, the 10-year back near 4.3. We have the dollar kind of was bottoming out, was kind of trying to turn a little bit. The commodities trade is back. It deflated Friday and a little bit Monday. Now gold is back, silver is back, copper is back. And so the market's just trying to find this some kind of macro equilibrium thrown into the whole mess. So we have a question here. So how do we know what decides you're right for the market from the impact of Trump? How do you know Trump will have to improve the down at the end of the day? Okay, well, the short answer to that, without being glib, is we have to keep our eye on where the large positions are and if we're over or under them. So if there's, I'll just oversimplify it, if there's customers long puts and that we're right near that level and it's getting toward the end of the day and we stay above them, then they decay and charm pushes us up to wherever the next level is. And then as the time of the day shrinks, then that area kind of contracts and becomes more and more where are the market makers, where are the options going to decay from?
Share my screen for a second, and
Okay.
you can
Oh,
use
you
that.
have something? Good.
Yeah, you can use that to illustrate what you just said from a plain vanilla open positions, right? So the purple bars are puts and the green bars are calls. And if you if you sum them up or squish the chart, if you will, then obviously you can see that the put dominates from the puts. The purple bars are higher than the green bars. Very obvious from 69.30 and under. And the green bars are larger than the purple bars from 69.40 and above, other than this strike 69.60. Yeah. So if we are stuck around 69.30 afternoon, let's say 2 hours into the close, especially 1 hour into the close, charm has a very large influence as time passes, but it's an exponential influence. So 1 hour into the close, it's very dramatic, but 2 hours into the close, less so, and 3 hours to the close, very, very less so. So the market will go up and down, do whatever it wants, but let's say 1.5 hours to the close, if we are above these puts, so 69.30 and above, then all this group of puts contribute to the charm, which is supportive. Obviously, the strikes closer to the spot contribute more, but basically the decay from left to right, right? So as charm kicks in, all these puts will contribute to a supportive type of dynamic and maybe push it up. But on the other hand, all these green bars will push the market to the downside from a charm perspective. And even if there's no trading, so only market makers are active, they still buy and sell futures based on these dynamics into the close, and that buying and selling creates a certain path that Doc can show you on the option depth charm maps. You can see the path right now. It will obviously change throughout the day, but that squish between the two charms, between the call charms and put charms, basically provides some type of path. Could be up, could be down, for the spot, starting at around 1.5 hours into the close. That path will be more influential on the spot over other Greeks compared to any time before that. Now, one thing to remember is that charm is a passive force, meaning that, let's say we're 1 hour into the close, charm is in full effect. But if you get news and the spot moves, that's it. That charm doesn't have the same influence as it were if the market is pretty much quiet into the close. So remember that charm is important as long as the volatility is low into the close. If the market is...
And that's what happened. I want to jump in there because I think yesterday was a good example. So yesterday, toward the end of the day, as we were heading back up toward, well, I want to show them something. Let me actually pull up just a chart to illustrate price movement. So yesterday, toward the end of the day, where was yesterday toward the end of the day? Okay, where were we? Okay, Wednesday, blah, 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 where are we? Okay, yesterday toward the end of the day, if I could find it on this chart, I'm gonna go over here. Yesterday toward the end of the day, as we were heading toward that 6,900, that was sold puts. Okay, so that was positive gamma. So that was keeping us under it, until, but volatility went down, changing the deltas, and then we flipped above it. Once we flipped above it, we had this. We had this dramatic, 68, 90. Once volatility came down simultaneous to this, that's when we got the flip. Had volatility stayed where it was or gone up, then we would have been buried underneath it. So there's more than one factor in there because the deltas and the decay is going to be influenced by volatility. You can almost think of volatility and theta as different versions of the same, different sides of the same coin, because theta or volatility is how much we expect it to move over time.
By the way, if you want a good level for volatility this week, as a rule of thumb, under the current VIX regime, for whatever reasons, I won't go into it, just have a line on 17.
Yeah.
We will be generally sideways to up, supportive if we are under 17, but we will be trending lower as long as we can break down under 17 on the VIX.
Okay, that's a good rule of thumb.
But this is for this week, yeah? This is only for this week, yeah?
Okay, we're going to wrap it up here. I got to get some trades in, answer some phone calls, whatever. Thanks for the question. Did we answer it? Because I don't want to leave a question unanswered. I know it's a hard thing to answer in one, oh, that was amazing. Yay, thank you. So then give us a like and a retweet, please. Okay, and let me show you one last thing on the map. Okay, hold on. So here's the char map. Just think simply, the yellow is suppressive. So if we're under here, we stay buried under the 6990 and we kind of like hang in here. If we're above the 6900, then we have this long way to go, anywhere between 6900 and 6940, and it's broader throughout, at 10, 11 o'clock, there's really not going to be as much influence. And as we get later in the day, then that cap comes in up above where, where the options are going to be decaying, and that kind of smushes us down toward that level at 6940 we've been talking about, unless we're over here, and then the whole colors of the map would flip. So anyway, yeah. Okay. Thanks a lot, everybody. And
thank you.
Take a look at what's going on in the chain and trade safe. It's a treacherous market, size appropriately, et cetera, et cetera. Take care. Thanks, Val.